Hi, I'm Rashawn Levin with Keller Williams Realty. So today I'm going to talk about the document that you will get from the title company. It is called your closing disclosure. This is the document that you will actually sign. And it will have this one that I'm going to go over actually has the seller side as well. So I'm going to go over it. So the original one that I talked about was actually your loan estimate, your closing disclosure. You may receive one initial loan estimate, and then you'll receive a closing disclosure, and then you'll receive a final one, because the final one has every document, every itemized. So what the lender does is they will send you an estimate, and then at some point when they give you what's called a clear to close, they're going to do what's called that the numbers have to be balanced, which that happens on the back end. You would never know that. I'm just telling you. So a lot of times people, oh, I'm clear to close, so why can't I close? But some things on the back end have to be verified, and the lender sends the package to the title company, and the title company works on the numbers, and they go back and forth, and the numbers have to balance. So that's what that is. So let's go over this. I hope this is educational for you. If it is, please comment and share with others, because I believe in education. When we are educated, we are powerful. So let's get started. So your closing disclosure at the bottom on the left-hand side, it's going to be the date that it was issued, the closing date, the disbursement date, which means when is the money going to be given, the actual settlement agent, what is the file number, the property address, and the sales price. Then the middle column is the transaction information. So that's the borrower, so Michael Jones and Mary Stone, where they currently live, the seller, where they currently live, who's the lender. The third column is going to be the loan information. So this is the loan term. How many years is it? What's the purpose of it? What is the loan product? The loan type. So in this case, it's conventional. If it was FHA, that would be checked. If it was VA, that would be checked. If it was something else, the fourth box would be checked, and then it would say what type of loan that was. Loan ID, that's the loan number, and MIC, not really sure what that is, but we're going to move on. That's not really important. So your loan terms is this section. So the loan amount, the interest rate, the monthly payment with principal and interest, is there a prepayment penalty, balloon payments. So keep in mind that wherever you are in the country, the document will look like this. Of course, the sales price and all the fees will be different, but this is a standard form. So wherever you are, you can learn from this. Whether you're purchasing in my area or not, you're getting a loan, this is what you will have. This is what you will see. So projected payments. So payment calculation. What's going to happen between 1 to 7 years? What's going to happen between year 8 to 30 years if it's a 30-year loan? If it was less, then that number would change. So it's your principal and interest, your mortgage insurance, your estimated escrow. Now these two items might not change, but in this particular instance they do change because the mortgage insurance dropped off after year 8. So that might necessarily happen for you. This is just for educational purposes only. I will disclose that. So estimated taxes and insurance. So this estimate is for the property taxes, insurance, and in this case there is an HOA, which is a homeowners association due, which homeowners association dues are not calculated in the mortgage payment. So that's why there is a difference here. So you see the difference. I get this question a lot. So why is my escrow and then this payment different? The difference is the HOA is not paid in the mortgage. So that's why there's a significant difference. I'm not sure how much that is. It kind of looks like, let's calculate it. Let me see. That is, HOA is $150 a month. So that's the difference there. That's why you would think that that's a discrepancy. So costs at closing. So closing costs, I'm going to go over this more in detail, but you're going to see this because it's on page 1. So they're going to tell you what the fees are and then go over each of them line by line. I won't do that in the video. It's going to take too long. But for this educational purposes, you'll see what it is. So closing costs and then cash to close. This is this amount. So let's go over it. So when we're looking at this, we want to only look at your side. So what you need to be concentrated on is what you are responsible for, not the seller side. Doesn't really matter about how much they're getting or how much they're paying out. That's not your concern. So for this example, so the first part is the loan cost. So that's your origination charges. So the top, so this is everything 1, 2, 3, and the one in bold is the actual total of those items. And just so you know, are they actually added up right? You could actually sit there and add them up, but they have software to add them up. So it's not like somebody is actually putting these things in and then putting the number in. What you want to make sure is the actual fee correct for that item. That's why they send you the disclosure first, earlier, 3 days before, so there's no issues later. So section B is services the borrower did not shop for. So these are things your lender had and done for you on your behalf. You paid for them, but you didn't have the opportunity to choose. You can't choose who your appraiser is. They give it. They tell you that it needs to be ordered and you have to pay for it. In this example, though, said it was paid by others. So that could happen. Usually it's on the borrower side, just so you know that it is your fee, and it's usually what's called POC, paid outside of closing. Flood insurance, so those items. Section C is services the borrower did shop for. So these are things that you could have chosen on your own. And then in the top section here is the total of those items. So everything above A plus B plus C is what D equals, which is the 46.94 and 5 cents. And then now we go to the other costs. So E, so that's taxes and other government fees. What I want to point out is it's other fees that may not be listed here. This is just a guide of where those items will be when you actually settle. Because there's tax stamps, there's other fees actually in Virginia and Maryland and DC that aren't here. So just want to point that out. Prepaid, so this is your mortgage insurance. If you have mortgage insurance, your homeowner's insurance, prepaid interest based on when you're actually settling. So if you're settling, in this case, you're settling on the 15th, so they take it till the end of the month, so you're paying per day for interest. And then your first payment in this case, because you closed in April, your first payment wouldn't be until June 1st. Property taxes, they're collecting 6 months. They usually collect about that much. And then starting your initial escrow payment at closing. So they want to start what's called an impound account. So they have to start this up ahead of time because it's when the bill is due, because the lender pays for your homeowner's insurance and taxes for you. The money has to be there because they can't have a shortage because they're going to ask you for the money. So that's why they collect, depending on the time of year when you're closing, when that amount is due, it could be a lot. So just keep that in mind. And then other charges, since there's an HOA fee, there's a capital contribution, processing fee, home inspection fee, and it says real estate commissions, but that's on the seller side. Not homeowners insurance, sorry, and owner's title insurance. So that is optional. I would recommend that you get that. Whether you're buying new construction or not, you should get that because that protects you. I have another video on explaining why you should get it when you close. And it's a one-time fee. So this $1,000 is not like you have to pay that every year. It's just one time, and it's basically you have that for your life. And then total other charges. So that is E plus F plus G plus H. That's added there. So remember D, we were all the way up here. So that amount here, total loan costs plus other costs comes up to this amount. And the reason why there is a difference here because that was actually a credit. So that's all for that page. So now we go to the third page, calculating cash to close. So on the left side, this was based on your loan estimate that they gave you. If you watched my loan estimate series, you would have seen that. And then the final, this is what the real number is. So there can't be a huge discrepancy because they would have to, they would call it, I can't remember the name of it, but they would have to give you a lender credit if that was a significant amount of significant difference between the two numbers. So it couldn't have been 20,000 here and then 45,000 here because that's a big jump. So that they missed the mark. So now this is a summary of the transaction, kind of similar to what the Alta statement looks like. So this is all the charges again, which is just a summary of the transaction. So it's not more dues, it's just a breakdown so you kind of understand more. And I'll just scroll down the page so you can see. All right. So additional information about this loan, that's on this page. That's on page 4. On page 5, these are the loan calculations, other disclosures that they have to give to you. At the bottom, contact information is going to be your lender information, mortgage broker if there was one, real estate broker for the buyer, real estate broker for the seller, and the settlement agent, and everybody's contact information and license number. And you will sign the bottom end date. Thank you so much for watching. I hope this was helpful to you. Please like, comment, and subscribe. Bye.